Ladies and gentlemen, you're listening to another edition of DIY Money.
DIY Money.
Any idea when this podcast today, which we are recording on September the 16th, will air?
I do. I have a spreadsheet.
I'm just curious because I want to think about.
Give me a minute.
There's so many things going on in life that maybe by the time this airs, something dramatic will have happened in one of our lives that I just want to, touch upon. I know I'm stalling. It's okay. I never give Daniel an update about what we're going to talk about in the Bro Talk section of the podcast. And yes, I just called it the Bro Talk section because that's what it is. It's the Bro Talk.
I think it's the 29th.
Of September.
I believe so.
Oh, okay. So that's not bad. It will be beyond my 17th year anniversary, which is on the 25th of September. Booyah.
Accepting gifts?
No.
That'd be weird.
That would be weird.
Congrats for being married 17
years. And I'll tell you, they talk about the first, 10 years, specifically that 7th year. And I was, thinking, man, this is, if I can get past that 7th year and get into the 10th year, I'll be looking good. Now I'm like 17 years. We are stronger today than ever before.
You guys are a good team.
We're a good team, and we complement each other. I stay in my lane. I mean, when I veer out of my lane, it's ugly. And she stays in her lane.
She calls it as it is.
And yeah, it's a really good team, and it's taken a long time. But we're not going to do anything this year. We have too many activities coming up. The swim meets.
So you're going to do nothing.
Meaning we're not going anywhere.
Okay.
I love to travel, as you know, but we're not traveling this year. We're going to UK plays South Carolina. Go Cats. Will Levis. Boom. Holy cow, is he crushing it.
What are the South Carolinas?
Gamecocks.
Okay.
Anyways, so we're going to watch that game. We were going to think about going to that game, but just too much on the horizon because what I was curious about, the reason I said that is the first of two major races for me is coming up mid-October. New Jersey, Atlantic City, half marathon, October 16th.
Nice.
And I'm not going to put my time goal out there because I haven't really committed to it yet.
Well, we need to put that on the walls around the office or something.
Like my time goal?
Yeah.
No. I'm
squeamish. What's going on?
Well, because I don't know. I'm not going to set a time goal unless I know it's achievable. I did 5 miles this morning at that pace that I'm contemplating shooting for, but I'm not going to lie. I was dying at the 5th mile. It was ugly. I had to tune on the Rocky, Let me tell you something.
Cool.
Life isn't all sunshine and butterflies or whatever it is. We talk about that in the tribe a lot. Speaking of the tribe, Facebook DIY Tribe on fire. I haven't dropped a lot of content there lately, but I got there's been a lot going on, but I'll get back into that for the Q4 because Q4 is where it's at. You're rounding the third and you're coming for home and the year and, goals, objectives, etc. What else is going on in social, the world of social?
I mean, we're blowing it up with videos.
Instagram climbing. Are we at the 10,000 mark yet?
Negative.
Where are we at there? About
we're
4,000?
Rounding 4,000.
Okay.
Soon.
Well,
by the time this releases, we'll probably be at 4,000.
Friends, family, come on, get them on the Insta.
Create some new accounts.
Yeah.
Just
why don't we do that?
I don't know. Because we like to be genuine.
There we go. All right, let's roll into our question. We got a good one today from a young lady who obviously has it together. So I'm not sure what we're going to add to this question.
Not sure why she's asking us.
Yeah, but it's a great question, and I think she gives us some accolades in the beginning, so maybe that got her on the show. Anyways, Alexandra, is that right?
Sure.
Alexandra, what do you got?
Hi guys, my name is Alexandra. I'm 26 years old and I live in a suburb of Washington, D.C. I feel really comfortable with my finances right now and need some help on where to go from here. I'm in a stable job that I enjoy and I make about $65,000 a year, and I'll likely be able to make $100,000 or close to by the time I'm 30. I have no debt, I'm not married, and I don't have children, but I plan to have a family in the future, so I really want to invest as much as I can while I have the money to. I have 6 months of living expenses in a high-yield savings account, a few thousand put away in a bank savings account as a sinking fund. I've been able to max out my Roth IRA the past couple years, and I contribute 10% to my 401k, and my company contributes 3%. I can afford to invest an additional $200 to $300 per month, and I've been doing some research on ETFs and index funds, but I don't really know where to start. My Roth IRA and 401k are all invested in target date funds. Should I invest some of the money in those accounts into index funds or ETFs? Do I need to open another account to do that? I could really use your advice on where and how to invest my money in the smartest way. Thanks so much.
Wow.
Yeah. She's on the
Wow.
DIY money plan.
On the DIY money plan, someone has invested in her financial acumen. My guess is it was spoken about around the table, infused maybe in the family. I mean, just unbelievable. So rough numbers. I'm actually going to let you answer that question.
Which one?
There
was multiple.
The question of where to invest, et cetera. I'm going to let you handle all that stuff. But
What are you going to do?
I'm going to applaud her and run some numbers because this
Okay.
is awesome.
Well, you give her a pat on the back, and then I'll give the content.
Yeah, this is going to be good.
Okay.
So let me build it up and then I'll share with you. Roth contribution, she maxes out $6,000 a year, correct? She says she puts in 10% of her income. She's making $65,000 a year, so that's $6,500 a year. Her employer puts in 3%, so that's another $19,550 a year. So right now we're at $6,000, $6,500, and $1,950 a year going into retirement savings. She talked about having another $200 to $300 a month for general investing. So let's just say $2,400 a year for that. So that'd be the $200 a month. So we're going to add all that up, and we're going to say that she is putting in $16,850 a year towards her retirement and future at 26 years of age.
And already has a 6-month savings.
Yeah, I'm not going to worry about that.
That's impressive.
It is amazing. So let's say she had nothing invested today. I've got my future value calculator out.
Oh, fancy.
Yep. If you were interested, it's on YouTube. Not the calculator, but just me punching in the numbers. But I'm going to say she has nothing starting, like zero. So she already said she's been able to max out that Roth. So no, let's not do that. So how many years do you think she's been able to max out the Roth? 3 years, 2 years? What do you think?
Let's go 3. Why not?
3 years. All right. So we got $18,000 as a starting balance. She probably has some 401k, et cetera, but let's just go with that. Periodic additions on an annual basis, we're going to do $16,850. She's 26. So let's run this out till she's 50. All right? Just 50. So, I mean, theoretically, it'd be 59 for retirement, 59, 60 for retirement. Let's just go 50. All right? So ultimately, that's what, another 24 years, right? 24 years if she's able to do this. And oh, by the way, I didn't factor in if she starts making the 100 G's she talks about. So what kind of rate of return you want to give her? Just to be, methodical. What do you think?
She's investing pretty, I don't know, 7.5%.
Why do you have to
8%.
use a half?
Why not?
I don't know. I like round
calculator
numbers.
Do half?
It does
Come on.
half, but okay. 7.5% return. All right. Starting balance 18,000, which is probably low. Periodic addition 16,850 for 24 years. Any guess?
No.
$1.1 million by the time you're 50, including no more additions.
Can we take that out to 60?
So that would be 34 years?
Yeah.
Oh, you just want to get cray-cray and show how amazing
because the compounding there
interest
for the
is.
next 10 years is going to be
like
amazing.
a hockey stick.
Yeah.
34 years from now, $2.6 million.
Great.
Now, let's think about that in terms of income, because this is what I like to do for folks kind of working backwards, back of the envelope, and I know it's not complete CFPP type stuff.
Sure.
But if we had a $2.6 million fund and she was able to generate 5% on that, again, that's a lot, but never know where interest rates are going to be in 34 years. That's $130,000 income from her investments. Now, for those I lost, let me share with you all that we did. We took what she's doing right now, no changes whatsoever. We put it out till age 60. And then we said, what if she withdrew 5% of that amount every year for the rest of her life? She has set herself up to have a $130,000 income stream at the age of 60. I told you I was going to answer no questions. I was just going to basically share how amazing that path is. Amazing.
Great.
Okay, go.
Astute using of the calculator.
Thank you very much.
I really
Thank
like
you.
that.
Mhm.
Yeah, so the basic premise of the question was with the $200 to $300 extra a month, where sort of to invest that. And she threw out index funds and ETFs, I believe the question said, which inherently there's a lot of overlap there. So index funds are any fund that invest in an index. So like the S&P 500, the Dow Jones, there's a multitude of other indices, which is the plural of
always
index.
think it's indices, and then I hear people say indexes. So I'm just going to
Which
say
sounds
it's
weird.
indices.
Indices.
I like it. It sounds more intelligent, too, like index and then indices. Indexes? Then I don't like
Nobody
that.
does that.
Nobody does that.
Nobody in the know.
I
I don't know.
It's like when you say finance.
Yeah.
Like, I'm in finance.
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 Interesting.
Instead of finance. Finance. Come on. Here we go. Keep
Moving
going.
on. So an index fund is anything that invests in an index. That could actually be a mutual fund, or it could be an ETF, which is also a fund. An electronically traded fund is what ETF stands for. They're actually pretty similar. So an ETF trades throughout the day. You can buy it in share counts, though some places now do allow you to buy it in dollar amounts. A mutual fund, you can also buy in share amounts or dollar amounts. They trade at the end of the day, so you get one price at the end of the day. For most people, that's not going to make much of a difference. So really, for all intents and purposes, they're pretty similar. Now, if you're investing in a taxable account, an ETF is slightly more tax efficient for those that are concerned about paying the least possible amount of taxes on their investments. You can also pick and choose what tax lots you can sell on those a little bit easier depending on how your account is set up. That's kind of getting into the weeds on a little bit of that. So when you're looking at this individual account, which is what you're investing in, so if you don't want to invest for just retirement anymore, if you just want to invest for long-term goals, you stay away at this point from the Roth IRA, the 401k, just chucking more money into those and focus on what's called a taxable account. It's just an investing account that's similar to your bank account, except instead of just putting cash in it, you're actually putting investments in it. The upside to that is it's available anytime between now and forever, really. It's just very available assets that you can invest. You can open it up. You can invest in a target date fund. You can invest in the S&P 500 fund. Really, whatever matches your goal time horizon. If you don't have a goal time horizon, you can pretty much invest in whatever makes sense to you, which might just be the total stock market.
Only thing I want to add there, she mentioned not owning a home, but setting up to, own a home, potentially have a family in the future and so forth. Yep. So that's introducing a new set of goals. And I think that, Alexandra, you want to take maybe a look at previous podcasts we've done where we talk about saving for those goals that are within the next, 5, 10 years, et cetera. Now, if you have another plan for the down payment, which she didn't mention, but she may have another plan that's already set up for a down payment, then you don't have to kind of worry about that. You've already set that up, and maybe this $200 or $300 is extra.
Yep.
So I think if it's extra and you're looking for investing, again, I mean, you didn't tell her which one. I know we can't tell her which one, but
well, yeah, we can't tell her what to invest in.
If it were me, I would just stick with the index funds, mutual funds. It's simple. Like you just get an index mutual fund, you buy it, you put it on automatic, rebalancing, dividend reinvestment, and you forget about it.
Yeah, and most major brokerages, so not Robinhood, they're not what's considered a major brokerage. They're more of an app or a smaller brokerage, but major brokerages, which would be Schwab, Fidelity, TD Ameritrade is now Schwab mostly, but they have their own sort of S&P 500 index fund, things like that. Vanguard is in there too. So regardless of where you are, you can kind of find a S&P 500 or a total stock market.
I wonder what she has in her Roth. I wonder what she's doing in her Roth.
Funds.
Oh, is that what she said in her Roth? Oh, okay.
Which you could pick that. So the difference between a total stock market, a total U.S. stock market, and a target date index fund that has a far enough date, like 2060, 2065. I don't know if there's any 2070s out yet. The only real difference between those two is the target date fund is going to have total stock market in it, but it's also going to allocate to global markets. So you're going to have some international, some emerging markets, potentially some real estate, and you might have a very small portion, 5 to 8% in some bond funds, just to give you diversification. So if you don't want to invest in just the total stock market, you can do a target date fund in just your general investing account, and you can actually shorten that date if you want it to be for a 10-year goal. You can kind of shorten that date from the 2060, 2065 to the 2030 fund. Just know that those will probably be a little bit more aggressive than typical a 10-year goal time horizon would be, because they're made for you're retiring at 2030 and then having 30 years that you're going to use that fund, not like you're have a goal at 2030 and all of a sudden just going to have cash. So
it's a great question, Alexandra. Hopefully we shed some light on your situation. Keep up the great work for sure. And obviously we'll send you your $25 Amazon gift card. Remember, friends, the secret to wealth is pretty darn simple. Live on less than you make. That's the hard part, really. Invest the rest and do so for a very long time. Make it a great one.